Hello warriors, I hope you're all doing good. So let's start the revision for the transfer pricing part of the topics. This is again for your CA final November 2024 exams. Let's look at the topic quickly. A very easy topic, fairly to understand from an exam perspective. Very little topics for you to go through. So let's look at it quickly. Yes. Starting the transfer pricing topic, the provisions first of all come and say that this provisions will apply for any kind of international transactions which are undertaken by an AE. Yes. So the provisions start with section 92, which comes and clarifies that if you're going to have any kind of income, an expenditure, an interest, an allocation, cost, expense, basically whatever it is, with relation to an international transaction which is undertaken by an AE, or if it's any kind of specified domestic transactions, then in that case the provisions of transfer pricing will apply, and any kind of payments have to be happening at an arm's length basis. Yes, exception to the rule will not apply in case the arm's length is going to result in India making a loss, meaning the value of Indian income comes down or the losses increase. In that case, ALP will not apply, transfer pricing provisions will not be taken into consideration, and the provisions will apply as it is. What do you mean by an AE, people? The first few items to be noticed upon. AE is basically coming and saying two entities will be called as an AE if follows. If any of these are following satisfied. These are questions which have come in exam, so please pay attention to it. The provisions are coming and saying the first thing, where you are going to have at least 26% of the voting power of the company. 26% of the voting power of the company. So if one company is holding at least 26% of the voting power of another company, they'll be called as an AE. Second, 26% of the voting power of both the enterprises are held by a same person, meaning I have a common parent. Third, any kind of loans or advances are given to another entity where 51% of the book value is coming from such loan. 51% of the book value is coming from such loan. Notice for all these items, it is any time during the previous year. So on any random day, if 51% is breached, it will become an AE. Point number 4, where the enterprise is guaranteeing at least about 10% of the total borrowings. So whatever borrowings I'm taking, my AE is guaranteeing at least 10%, they become an AE. Next, enterprise is appointing more than half of the board of directors of this company, or are at least appointing one executive director or members of the entity, which means the major decisions are being made by the other entity by appointing their boards, or at least the managing director or the executive director is done by this company, because then you also have the powers to make decisions. Next, more than half of the board of directors or at least one director is done by both parents, both companies having a same parent. So which means one person is doing it for two different entities, then also these two entities become an AE. Then enterprise business is wholly dependent on the know-how, patents, copyright, etc., which has been taken from another enterprise. Which means my business itself is running because I'm completely dependent on your entity. If your brand name is not there, I cannot run. If your trademark is not there, I cannot run. So all intangible relation items, 100% dependency is there on you, and therefore you are my AE. Next, at least 90% of the raw materials are supplied by this enterprise. At least 90% of the raw materials are supplied by this enterprise, either directly or through some other person, in which the prices and the other conditions are influenced by the other enterprise. Meaning 90% of my materials are coming from one person. If it is not, it is coming from another person. But for the other person also, this person is giving instructions. Understand, these all provisions will not apply in case the other person is not giving instructions, or if the person is giving instructions to sell at market value. This will only happen if the market value is getting influenced by the other person. Meaning if the question comes and says that the AE which I have is actually giving him a decision and coming and saying that you can go and buy it from a third party vendor, but you can pay him the market value. In that case, there is no violation of conditions and the AE will not get satisfied. Next, goods or articles which are manufactured or processed by an enterprise and is sold to the other enterprise, such that the prices and the other conditions is influenced by the other enterprise. Notice one thing very carefully. When it comes to my raw materials, I have to satisfy minimum 90% criteria. But when I'm selling, there is no criteria. If I'm selling to someone and this price is getting influenced by another person, the other person becomes my AE. Next, individual controlling the enterprise, also controlling the other enterprise. Whether they do it directly or they do it through his relatives. Finally, where the head chef is controlling the enterprise, the members of the head chef will also become my AEs. Any enterprise holding 10% interest in the other enterprise, being a firm, AOP or BOI. So if it's a firm, AOP or BOI, if they're holding 10% in my entity, then also it is AE. My AE. 1 second. Yes. What are the balance? Any other relationship of mutual interest which is done between two enterprise? Basically, this is a blanket thing which I see income tax is not notified anything yet, so therefore you don't have to worry. Yes, this is the definition of AE, people, which you need to keep in mind. Questions may come in exam where they may come and ask you to define whether the person is an AE or not. So these kind of definitions to be kept in mind. Next, what do you mean by an international transaction? Income tax is coming and saying international transaction are basically those transactions where you are doing a transaction between two parties who are an AE. One of whom at least should be a non-resident. Understand? One of whom is to be a non-resident, meaning doing transaction between two domestic people are not going to be called as an international transaction for transfer pricing. It will only be done if at least one of the parties is a non-resident. It can so happen that both the parties are also non-resident, but one of them at least has to be a non-resident. Income tax says where both of them are going to be non-resident, TP provisions will apply only if the income is going to be taxable under Income Tax Act. Meaning if you're doing transactions fully outside India, nothing to do in India, India does not have a botheration. But if any of the impact is going to come back to India because they're going to pay taxes in India, then in that case transfer pricing rules will apply. Second, any transaction should be in the nature of sale, purchase or lease of any property, provision of services, lending, borrowing of money, apportionment, allocation. Any kind of transaction is called as international transaction, it doesn't matter. These transactions will be covered under transfer pricing provisions, whether it is formal, in writing or intended for legal enforcement, I don't care. Any kind of transaction happening between a person and his branch, if it is happening between a person and a branch, income tax says tell me who is the main branch and who is the foreign branch. If it is a resident assessee undertaking with its foreign branch, then it is not an international transaction, because anyway you are going to pay tax on all the incomes of the foreign branch in India as well. But if it is going to be a non-resident assessee with its Indian branch, then it will be an international transaction, because to the extent of the Indian branch income, it will be taxable in India. It will be taxable in India. Same coming provisions. Yes. What do you mean by deemed international transaction, people? It is not tested in exam so much, but a clarification from Income Tax Department comes and says deemed international transaction means that two entities are getting into a transaction, it will be called an international transaction. But if the transaction is happening with a third party, where the AE of mine is influencing the decisions, whether AE of mine is influencing the decisions, or because my AE is entering into a prior arrangement with another person, the decisions are being influenced there, then this transaction also will be covered as an deemed international transaction. For example, if I am going to enter into a transaction between R Limited and non-AE, for which my AE is entering into a prior agreement to carry out the transaction, then in that case, even though the transaction is happening between Rahul and non-AE for a non-AE transaction, it will still be called as an international transaction for the purpose of transfer pricing. Yes. Second, what do you mean by a specified domestic transaction? All those transactions which as per income tax is going to save taxes in India. Meaning if you do transactions with tax holiday entities, they're coming and saying if you do any intra-unit transfer between section 80A, if you do any transaction with section 80IA, if you do any transactions between AE and his closely connected persons referred to in 80IA, if you do any kind of transaction which is happening with section 10AA, which also applies for section 80IA entities. Finally, if you're doing any transactions with any 115BAB entities or 115BAE entities, because they are paying taxes at 15% flat, and any other transaction, provided the transaction exceeds a value of 20 crores, provided the transactions exceed a value of 20 crores condition to be mandatory satisfied for you to apply international specified domestic transactions, otherwise SDT will not apply. Yes. Next, how do you determine arm's length pricing? Income tax says there are 1, 2, 3, 4, 5, 6 methods for you to determine arm's length pricing. First one is cup method, resale price method, cost plus method, profit split method, transactional net margin method, and your other methods. Income tax says, how do you determine cup method? They're coming and saying, if you do this transaction and the same transaction or similar transaction with a third party, what have you would charge the third party? What you have charged the third party, the same price is what you should charge your AE. The same price is what you should charge your AE. But yes, if there is any material differences which can impact the pricing, you can reduce that material differences. Fairly straightforward. In exam, if you see a question which comes and says, I am selling this to my AE for 100 rupees, whereas I would have sold this to my other person for 120 rupees, income tax will say you should have sold it for 120, and therefore 20 rupees will become your transfer pricing adjustment. Second, how does the resale price method work? They are coming and saying, I am selling it to my third party. I will reduce my normal gross profit margin. And then I will come and ask, what is the price which I should have charged? This is the same price which my AE should have charged me. Basically, RPM comes into a case where I am receiving raw materials from my AE and then I'm further supplying. Income tax says in that case, whatever price I should have charged my AE is what I need to compute. So I'm doing a rework. Take your sale price, remove your normal gross profit margin, and tell me what is the normal price the AE should have charged you. If the AE is charging anything higher, then in that case you will have a transfer pricing adjustment. Same provisions, people. If you have any material adjustments, material differences which can impact my pricing, please take those into consideration as well. Next, cup method, where I'm coming and saying that my services are being provided to my AE now. See, understand, this is a reverse scenario. In the first scenario of RPM, AE is providing me services and I'm further supplying. Cup method is a case where I'm going to provide my services to my AE. In that case, they come and say, tell me what is the direct cost and indirect cost which you're incurring. And then add to it the normal margin which you would have charged any third party. That is the price which you should charge to your AEs. If you get that money, great. If you get anything lesser, then it will be a transfer pricing adjustment. Next comes your profit split method, which comes and says that if both of you together are going to enter into a common transaction with a related party, with an unrelated party, if both of you together are going to enter into a common transaction with an unrelated party, take the profit which is going to be received and then split it into both the parties in the most appropriate measures. This one is a little technical because here comes an involvement of intangible assets as well. And therefore PSM is something which is normally not used very often, but it is there. Yes, and finally comes your transaction net margin method, the most common method which is there in transfer pricing, which comes and says do one thing. You determine the net profit margin of the enterprise from the international transaction using a suitable base. So first tell me what is the net profit margin. Second, determine the adjusted net profit margin from compared uncontrolled transaction using the same base. Meaning, tell me what is the net profit margin from a third party. Minus and plus all the material differences. Now compare both. If my net profit margin is same as their net profit margin, I am safe. If my net profit margin is lower, I am getting a transfer pricing adjustment to it. That is what TNMM looks like. Coming last to the other method. Other method basically comes and says, this is fairly like cup method. The only difference is now I am not talking about those transactions which are happening between me and my unrelated parties. This is market scenarios. For example, if I am supposed to give out a loan, if I check what is the SBI rate being charged, that is another method, which means I'm looking at third party comparables in the sense not of cup method, but to come and see what normal people would have done in the similar transaction. That is what other method looks like. Yes. Now question comes from transfer pricing method as to what period you should use. For the purpose of doing a transfer pricing study, income tax says that if it is RPM, CPM or TNMM, this resale price method, cost plus method or TNMM method, you can choose the current year data plus the last 2 years data as a weighted average. For the purpose of checking your transfer pricing margin. Please understand that when you do this, the current year data may or may not be available. But the past 2 years data would normally be available. In that case, please take them. But if it is any other method like cup method, PSM method and other method, if it is cup, PSM or other method, in that case I will take only the relevant current year data. Yes, they say when the price of any earlier year is not available, it is to be ignored. When the price of current year is not available up to furnishing return, the same can be found out during the assessment proceedings. An assessing officer can ask you to pull in the current year data because by that time it will be available. At the same time, during assessment proceedings, assessing officer has the power to come and remove some cases or add in a few cases if they feel that is more comparable basis. Now, how do you determine ALP, people? Income tax says when you have more than one comparable prices, tell me whether the comparable prices are more than 6 or less than 6. If it is less than 6, income tax says follow something called arithmetical mean method. But if the prices are more than 6, you will do for cup, RPM, CPM and TNMM method something called as range concept, and for PSM and other method you will do arithmetical mean again. Now what does arithmetical mean, people? Income tax is saying do one very simple thing. Take a simple average of all the prices. Yes, how do you look at arithmetic mean, people? I'm coming and saying do a simple average of all the prices which you have. Take a very simple average of all the prices which you have, and at any point of time, if you want to find out whether the person is within arm's length or not, you take the price, get the simple average and tell me whether the transaction price 3% pull if the arm's length price is falling. If the price of the arm's length falls within 3% of the transaction price, in that case, I will treat it as an arm's length transaction and I will not levy a transfer pricing adjustment. Meaning, for example, if I'm coming and saying that my arm's length price has come out as 100 rupees, add 3% to it. Plus or minus, meaning if the pricing of ALP falls between 97 to 103, I will call the person as being in arm's length. Yes. How does the range concept work? Here is where things go a little complicated. Income tax is coming and saying if you want to follow range concept, first of all take all your prices and arrange them in ascending order. Then find out the 35th percentile and the 65th percentile. What do you mean by 35th percentile? Whatever is the number of values. Let's say there are 8 values. Into 35% of it will be done and 65% of it will be done. The values, if they come out as a decimal, then you'll take the next limit. But if the value comes as a whole number, let's say if you do 8 and if you do median on 8, it comes as 4. If it comes as 4, you cannot take the 4 value as it is. Take 4 plus 5k average. That is what the provisions are coming and saying. Yes. So if I'm doing, let's say 10, let's say 10, I get 35 percentile 3.5. In that case, I will take 4. 65th percentile ka 6.5, which means it becomes 7. But if I'm doing median on it, which is 5, I will do 5 plus 6 by 2. 5 plus 6 by 2. This is what my range concept is. Yes, the moment you find your 35th and 65th percentile, this whole range itself becomes your arm's length pricing. This whole range itself becomes your arm's length pricing, where income tax comes and says, if your transaction price falls anywhere between this arm's length price, you are at arm's length. You are at arm's length. You will not be scrutinized for it. But if it falls outside this arm's length, you will then have to do a median concept. You will then have to do a median concept, where I'm coming and saying, find out the median of the value, and that will become the arm's length price. That will become the arm's length price. That minus the transaction price will become your transfer pricing adjustment. That minus the transaction price will become your transfer pricing adjustment. That is what the provisions are coming and telling. Yes, I have put in an example here. I'm going to wait for a second. I'm going to slowly turn down, pause at appropriate stages, and notice the example carefully. Yes, this is how it will look like. Yes, great. Let's proceed forward. We are looking at something called as comparative analysis. Now, this is a more theoretical part of the topics which has recently been introduced in your attempt alone, where they're coming and saying how exactly does the transfer pricing provision work. Yes, now this is a more theoretical topic which may come probably as a last question of your exams, but I'm not expecting much significance about it. So if you can remember it, otherwise ignore it. Go. It says, how do you do a comparable transaction and transfer pricing model? First of all, look for the following factors. You look for specific characteristics. Second thing, you look for something called as FAR. FAR means functions performed, taking into account the risk as assets employed and the risk assumed. Yes, do a FAR analysis of your transaction versus the third party comparable transaction and tell whether it is matching. Third, find out and look for the contractual terms of the transaction. And then look for what are the conditions prevailing in the market, because sometimes there may be extraordinary conditions because of which the margins may be very different. Yes, so look for these 4 characteristics in order to understand whether the arm's length pricing can be taken as a comparable measure or not, or if the value should be taken as agreed value or not an agreed value. Yes, then how do you find out a comparables, people? You can find 2 comparables. One is called internal comparables, one is external comparables. If you have third party transactions happening in your company itself, which can be suitably used as a basis, then that is the most reliable measure. And you use it as an internal comparable. But if you are not able to find such basis, you can find for some external comparables. Look for some third party softwares which will come and give you the financial data for other companies, and you can use that as a basis. How do you do the selection of comparables is what is given here. You have to check the database. Look for a database which gives you the most data. Something like Capitaline Plus, ProRes, and ACES TP database is what you can use. Then look for some quantitative filters. Put out filters in the database and tell whether you are finding the appropriate measure. First filter you will put is for availability of financial data, meaning if the data is available, take them as a comparable, otherwise ignore it off. Second, check for the industry of the tested party. You should both be in the same industry in order to find the best measures. Third, look for the turnover filter. If my company is doing more than 1 crore but the other company is doing less than 10 crores, it cannot be a basis because my values will be different from their values. Next, net worth filter. If I am a profit making entity where the other entity is a not making entity, it doesn't make sense. Similarly, when I'm loss making entity and the other entity is always making profits, it doesn't make sense. So those things will also be kept into mind. Export filter. If my company is fully into exports or the other company is not into exports, it does not make a suitable basis. If the other company is completely into export and I'm not into export, there can be difference in pricing. Take that into consideration. Expenses, employee filter expenses. If other entity is completely into related party transaction, then definitely that entity should not be taken because they are itself already in TP scrutiny. When they are itself into TP scrutiny, I cannot be using them as a basis for it because they are itself being questioned right now. And then if the other company is consistently making losses, look at all those filters. After you do the quantitative filters, also look for some qualitative filters, like check for whether their product industry is same as my product industry. Check for whether their functions is same as my functions. Check whether their ownership is government or private, because if it's government, then they may have a different pricing mechanism than what a private party will do. All these things have to be kept in mind in order to ensure that you are doing proper comparable search. Again, completely theory, people, not so important from exam perspective. Don't take so much risk on it. Yes, great. Let's move on to the smaller topics, the miscellaneous topics of transfer pricing. The first thing called as secondary adjustment. Income tax says that, boss, if you have entered into a transfer pricing adjustment and you have agreed that there should be a transfer pricing change to be made, meaning the transaction value was not at arm's length pricing, you will get into a primary adjustment. Now, the moment you get into a primary adjustment, income tax requires that whatever excess money is there with the AE, whatever excess money which is there in the AE has to be brought back to India. has to be brought back to India. That is called as secondary adjustment. That is called as secondary adjustment. Notice once again, what am I telling? I am telling that if there is a transfer pricing adjustment because of which India does not have the money which is required, the person will have to go back to the AE and ask him to give back the money. Ask him to give back the money. Giving back of such money is called as secondary adjustment. Giving back of such money is called as secondary adjustment. Income tax says that if at all there is any transfer pricing adjustment in the form of suo motu made in the return of income, in the form of made by the assessing officer during assessment, in determined during APA transaction, done as a part of safe harbor rules, or if it is agreed during a MAP procedure, then in that case these will be called as a primary adjustment. These will be called as primary adjustment, and a secondary adjustment will have to take into picture if these values exceeds 1 crore rupees during the previous year. If these values exceed 1 crore rupees during the previous year, where I will have to go back to my AE and come and say that please give me back my excess money. Please give me back my excess money. Yes, this excess money will have to be repatriated to India. However, later on there were some amendments which came and clarified that the excess money need not come from the AE. It may come from any of your AEs. It may come from any of your AEs, meaning it may not come from the current AE, but it may come from another AE also. It is perfectly fine as long as it is within the circle. As long as it is within the circle. How much is the excess money? The excess money is ALP of the primary adjustment minus the actual transaction value. That money has to be brought back. Now, this money has to be brought back within a period of 90 days from the due date of return filing if you accepted it in return filing, within 90 days from the date of order if it is done by an assessing officer during authority perspective, if it is an APA transaction, the 90 days from the date of filing the APA, and if it is safe harbor rules, then again 90 days from the date of filing the safe harbor rules. 90 days of filing the safe harbor rules. Rahul, what if I don't get the money within 90 days? Income tax says from the 91st day, it will be assumed that you have given a loan to the associated enterprise. From the 91st day, it will be assumed that you have given loan to the associated enterprise, and in that case, you will now have to start charging notional interest. You'll have to start charging notional interest. How will you do that? They come and say, if the value of the denomination international transaction was done in Indian rupees, if you entered into this transaction in Indian rupees, then take the excess money, post 91st day, and multiply it with the SBI's first year marginal cost of lending rate. SBI's first year of marginal cost of lending rate plus an additional 3.25%. But if you are going to enter the transaction in a foreign currency, then you will take the excess money multiplied by the SBI TT rate in order to get the number in Indian currency, and then multiply that by the 6 months LIBOR rate as on 30th September of the previous year plus 3%. Yes, understand, there it was 1 year with 3.25%, here it is 6 months with 3%. 6 months with 3%. This is what the provisions are. Yes, now I am coming and saying that, Rahul, in case I am not able to get the money, and I still want to ensure that I don't have this interest tax. Income tax introduced a one-time measure. Where they came and said that if you do not want to get back the money from the AEs, in that case, whatever is the excess money which you have, you can for once pay a flat rate tax of 18% plus a 12% surcharge plus a 4% cess, which is 20.396, I think. Yes, it will be 20.9664. If you make that much payment to me back, as a one-time payment, I will choose to not tax anything further. Mean until the day you don't pay the 20.9664, you will pay interest cost. After that period, you will stop levying interest. You will stop levying interest as an income. This is a one-time measure given back to you. Yes, I'm scrolling up and I'm giving you the example, people. If you want to note down if you want to check the example, you can check this example. Yes, perfect. Let's go forward, and we're looking at the balance topics, the smaller topics of the compliance procedures. Income tax comes and says, see, if you are liable for getting a transfer pricing done, I would need a CS certificate in order to prove that all your transactions are done at arm's length. So they come and say any person entering into an international transaction or an SDT transaction will have to get a Form 3CB filed by a CA 1 month prior to the due date of filing of return, where he will come and clarify as to whether all the transactions are done at arm's length. This form will have two parts. One will be part A, which will give the general information of the person, and part B, which will give the details of the international transaction. Part C will talk about all the SDT related transactions. Notice that in this, I will not be talking anything about my comparables. I will simply come and clarify to you that this is what the value which an international transaction party would have, which I have charged my international parties, and this is the value which is computed as per ALP transaction also. For all those things where you need to mention about whether the comparables, what are the comparables, how did you do the search and everything, we will prepare something called as a local file. We'll prepare something called as a local file. We'll discuss that right now. Yes. Now, how do you prepare that local file, people? There are two files to be prepared. One is called as local file, one is called as master file. Income tax says that if you are any person who's entering into an international transaction more than 1 crore rupees, you will have to mandatory maintain a TP study, or as we call it as TP doc or local file. Yes, this will come and mention about all your comparable searches and everything. Now, if it is requested by the assessing officer, this has to be furnished within an amendment period of 10 days. Within amendment period of 10 days, the moment an assessing officer asks, 10 days you have to give this data back to him. You have to give this data back to him. Where the total value of the transaction does not exceed 1 crore, prescribed documents need not be maintained, but it is required that the assessing officer asking you a question, you should be able to prove that evidence to him. You should be able to prove that evidence to him. Second, in case the transaction is going to have an effect for more than 1 year, you do not have a TP doc prepared for every year, while in practical world, you mention a TP doc for every year because there is a change in comparable data. There is a change in comparable data. For whatever TP doc you maintain, you have to keep it for a period of 8 years from the end of the relevant assessment year. From the 8 years from the end of the relevant assessment year. Apart from the TP doc, annually you also need to file something called as a master file. You need to file something called as a master file, where they're coming and saying any person whose international group itself has a consolidated group revenue more than 500 crores, or for the aggregate value of transaction entered into the current year, the transaction value exceeds 50 crores, or intangible asset transaction exceeds 10 crores. International transaction exceeds 10 crores. In that case, you will have to maintain something called as a master file. You'll have to maintain something called as a master file, whether or not there is any international transaction happening in the current year. Whether or not there is any international transaction happening in the current year. This information has to be given to the JDIT in form number 3CAA on or before the due date of return filing. On or before the due date of return filing. Understand, people, if you have to file the 3CB has to file 1 month before. But if you have to file a master file needs to be filed along with the return filing. Along with the return filing. The constituent entity will have to furnish part A of form 3CAA whether or not the limits are satisfied, and if the limits are satisfied, then he'll have to pull part number 3B. Part number B. Yes, so which means every person has to file a master file. If limits are not satisfied, just complete part A and close it off. But if the limits are breached, then you have to file part B also. Then you have to file a part B also. When there are more than one constituent entities in the international group in India, then you can choose one of the persons to file the master file on behalf of every other party. On behalf of every other party, they may coming and saying that, Rahul, every other party does not have to file a master file, but they will have to file something called as form number 3CEAB. Form number 3CEAB, where they'll come and say that I will not file the form, my constituent entity appointed person will file the form in the current year. Will file the form in the current year. Yes or no? Yes or no? Yes. Next, if at all you want to look at how to take the data in INR rupees, you have to convert that using the TT buying rate as on the last day of the accounting year, and whatever data you maintain should be maintained for a period of 8 years. In case you make a mistake and you levy a penalty, for failure to not furnish TP report, the penalty is given as 1 lakh rupees, and for making any TP adjustments, if at all you come and say there is a misreporting, then it is 200% of tax payable, but if you say it is underreporting, then it is 50% of tax payable. How do you do that? They are coming and saying, if you are going to maintain books of accounts as prescribed, declare the international transaction and disclose all material facts, then it is going to be 50% of tax payable, but if you make a mistake, then it's going to be 200% of tax payable. 200% of tax payable. Yes. Next, if you're going to fail to maintain or retain books of accounts, then it is 2% of transaction value. If you don't maintain correct information, then it is 2% of transaction value. Or if you fail to report any transaction, then it is 2% of transaction value. If you don't maintain your TP doc properly, then again it is 2% of transaction value. But if you don't maintain a master file, then a 5 lakh rupees ka penalty will be levied on you. A 5 lakh rupees ka penalty will be levied on you. Yes. Brings me to last few topics, which is called as a country by country reporting. Income tax comes and says, if you are a part of an MNE group, multinational group, who is having data as follows, they need to furnish the following data to me: the amount of revenue which is earned during the year, the profit before taxes, income tax and paid, total employment happening in each country, details of each company incorporated in all over the world. Now understand, because data is asked on a global level, it will not be done by every entity. It will only be done by the parent entity. And this whole transaction will only apply in case your consolidated group revenue is more than 6,400 crores. In that case, the parent entity will be the one filing the CBCR. The parent entity, if at all is there in India, will have to file the form within 12 months from the end of the relevant accounting year. Has to give this form to PDGIT or DGIT systems. Assuming I'm coming and saying that, Rahul, the parent entity is not in India. In that case, income tax comes and says the other entities which are there in India need not file the CBCR, but will rather file a CBC notification. They will file a notification where they'll come and clarify that my parent company is sitting outside India and they will file the CBCR in that country. They will file the CBCR in that country. I will not file the CBCR in India. If at all you require, you can collect it from that country's. If at all you can require, you can collect it from that country's competent authorities. Yes. So please understand, people, the difference between master file and CBCR. Master file, everyone has to file in India, even if your parent is going to file. But CBCR will only be filed by one entity, which is the parent company. Which is the parent company. If the parent company is filing it, other entities will summa file a CBCR notification, confirming that they will not be liable to file CBC. They will not be liable to file CBC. Clear? 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 Yes. Next, designated constituent entity comes and clarifies that if at all the parent company is not able to file the CBCR, if at all the parent company is not able to file the CBCR, or relationships of India is not so great with the other country that I'll be able to collect the data. Relationships of India is not so great with other countries that I'm able to collect the data. In that case, the PDGIT or DGIT will inform me that I will not be able to collect the data from the other company. So you are mandated to file a CBCR in India as well. You are mandated to file a CBCR in India as well. When it happens, when it is not obliged to file CBCR in that country, when India does not have an arrangement to collect the information from that country, or exchanging information from that country is not possible. Exchanging information from that country is not possible because there is an alien war. There is an alien war. In that case, any entity in India can be designated to file the CBCR also. Can be designated in India to file the CBCR also. In that case, you will have to file the CBCR. If there are more than one resident entities in India, any one of them will file it and the others will file a CBCR notification. The others will file a CBCR notifications. Yes, these are the provisions relating to CBCR. These are the provisions relating to CBCR. What is the issue if you don't file the CBCR? Income tax says where you are required to file a CBCR but you don't file the same. For the first month, you will be levied a penalty of 5,000 per day. For the subsequent months, you will be levied a penalty of 15,000 per day. But at any point of time, if the assessing officer asks you to file the CBCR and you still violate the conditions, from the day when you violate the conditions, from that day, 50,000 per day will be collected until you don't file the CBCR. 50,000 per day will be collected until you don't file the CBCR. If you fail to furnish any information which is requested from you, 5,000 per day will be requested from you because you have not filed on the time. You have not filed on time, and if the default continues, then they will ask you for a 50,000 penalty. At any point of time, if you furnish any inaccurate information to the officer because of some reasons, and you know that the information is wrong, assessing officer can levy a penalty of 5 lakh rupees on it. Assessing officer can levy a penalty of 5 lakh rupees on it. Yes, during an assessment procedure, income tax comes and clarifies the assessing officer can do a transfer pricing adjustment if he is of the opinion that the assessee has not computed an ALP using the most appropriate method. The information which is used by the ALP is not reliable or correct. The TP doc is not maintained and kept as per the provisions required by you. And assessee has failed to furnish the information when he was called for. Assessing officer will now be given powers to propose a transfer pricing adjustment. Will be given powers to propose a transfer pricing adjustment and do it as per his method. A case law which was then notified last year, which comes and clarifies that adopting a bright line test is not justified for benchmarking non-routine advertisement, marketing and sales promotion expenditures like AMPs incurred by a subsidiary for its AE, as it is not an international transaction. And hence in this case law, it was coming and clarifying that you will not be proposing a transfer pricing adjustment. When a reference has to be made, in order to do a transfer pricing adjustment, a reference has to be made to a person called as a TPO, a transfer pricing officer. Income tax comes and says where assessing officer feels that the case has to be referred to a transfer pricing officer, he may refer it to a transfer pricing officer in order to find out the transfer pricing adjustment. Once the transaction is referred to a TPO, the TPO can determine the transfer pricing adjustment for all other transactions also which may not have been referred. He can do it for all other transactions also which may not have been referred. Second, TPO can call for any additional evidences which he requires in order to justify his arm's length pricing. Whatever data is given by the transfer pricing officer is binding on the assessing officer. AO cannot go beyond the powers of the transfer pricing officer with regards to international transaction. But in this case, transfer pricing officer is mandated that he has to pass the order 60 days prior to the last date of completion of the assessment. If the assessment completion is on 31st March, by 31st January, the person will have to give you a transfer pricing order, which the assessing officer will have to use in order to pass his final order, in order to pass his draft assessment order. Yes, when a case is referred to a transfer pricing officer, please understand that the case will automatically be extended for an additional period of 12 months in order to ensure that the transfer pricing officer is able to do his arm's length search. arm's length search. Yes, the moment a transfer pricing adjustment comes into picture, section 92C4 comes and clarifies that any transfer pricing adjustment will not be granted any chapter 6A deduction or 10AA deduction on the TP adjustment. He will not be granted any chapter 6A deduction or 10AA deduction on the TP adjustment, and no deduction will be allowed to the total income of the other person. Just because you're going to collect the money back from the other person will not get any deduction of the same. You will have to take a permanent loss on it, meaning you will also pay tax, they will also pay tax. That is what the provisions are. Yes. If you are unhappy with the adjustments which are proposed by a TPO, if you are unhappy with the adjustments proposed by a TPO, they have given you an alternate mechanism called as a DRP. Rather than filing an appeal to a CIT appeals, you can also file an appeal to a dispute resolution panel in order to get a speedy disposal. In order to get a speedy disposal, provisions of income tax come and say where an adjustment is made for a non-resident, non-corporate or a foreign company. Non-resident, non-corporate or a foreign company, this person can go to a DRP for any TP adjustment made. Or if it is done for any other persons, it can be done only to the extent it is recommended by the TPO in the order. It is done only to the extent the recommendation is made by the TPO in the order. In that case, what will happen? First, I will go and inform the assessing officer that, sir, I need a draft assessment order. I need a draft assessment order. So you will go and request for a draft assessment order from the assessing officer. The assessing officer will take the draft assessment order, and within 30 days, you will have to file an appeal to the DRP. You will have to file an appeal to the DRP informing that I want to appeal against this. I want to appeal against this. If you choose to do that, then great. The draft assessment order will be put on hold. The draft assessment order will be put on hold until the appeal is closed. But if you choose to not do that, then assessing officer will immediately file a final assessment order. The assessing officer will immediately issue a final assessment order, against which now the only option for you is either you accept the thing and pay off the tax, or if you want, you can go to a CIT appeals. If you want, you can go to a CIT appeals. But let's come back and discuss about DRP. If I'm coming and saying that I have a draft assessment order, I can go and file an objection to a DRP, and the DRP will look into the case. The DRP will look into the case, and within a period of 9 months from the end of the month in which the draft order is passed, he will have to give his objections. He will have to give his proceedings. He will have to give his proceedings. This proceedings will then be binding on the TPO. So whatever proceedings DRP gives will then be moved on to the TPO. TPO will look at that judgment and revise his TP order. This TP order will have to be revised within 1 month from the end of the month in which the direction is received. Within 1 month from the end of the month in which the direction is received. And after this, if you are still unhappy, you will directly make an appeal to ITAT. You cannot now approach CIT appeals because DRP and CIT appeals are at the same footing. DRP and the CIT appeals are at the same footing. Yes or no? Yes or no? This is the provisions with regards to DRP. Now, please understand, people, when it comes to DRP, only assessee can file an appeal to DRP. TPO cannot file an appeal to DRP. When it comes to ITAT, also, I can go on an appeal against a DRP case. But the TPO or the assessing officer is prohibited to do so. However, when I file an appeal to DRP, if they want as an amendment of current year, cross objections can be filed by them in an ITAT proceedings. So which means they cannot go for an original appeal. But if I go for an appeal, they can file a cross objection to it. That is what the provisions come and say as an amendment of current year. Please ensure that you read this amendment carefully because this may be coming as an exam question in the current year. Yes, where the cross objections can be filed by the assessing officer against an ITAT case, but they cannot directly go for a main appeal. Are you clear? Yes? Great. Let's proceed forward to the last small topics of the chapter, which talks about safe harbor rules. Safe harbor rules basically come and say that if at all you feel like there is a risk in whatever you are proposing, you can use the references of what CBDT has given, and if you satisfy the minimum requirement of CBDT, I will not be taxing anything further. Now, for your exams, this has not been notified, and therefore it is not relevant from exam perspective. You can ignore it and go. Next is your advanced pricing adjustment, where income tax comes and says if you are feeling that whatever model you are going to get into may not be fruitful for you, and you see a potential risk there, you can file for an advanced pricing agreement with the CBDT. Where you can request that they can predetermine what your arm's length transaction should be looking like. Meaning they can predetermine and come and tell you what method should be applied and what margin should be applied. Or they can expand the scope and also come and tell you whether the provisions of section 9, which is income deemed to occur or rise in India, will apply in your case or not. If you do so, what will happen is the agreement which you get right now after approving by CBDT will become binding on your officer. Meaning if you if you ensure that you satisfy this much, officer cannot come and question you. Officer cannot come and question you. This is called as advance pricing agreement. Yes, let's read. It says, in order to ensure better methods on transfer pricing and to provide certainty of the approach, you can go forward and file an application to CBDT for determining the arm's length price or specifying the manner in which the ALP should be computed, or in order to determine how much of the income is attributable under section 9. How much of the income is attributable under section 9. Once ALP is entered into, the ALP will be deemed to be binding on the officer, and any past proceedings will get violated. While advance pricing agreement can only be filed for the future 5 years, they also come and give you a benefit to go for a rollback. Where they come and say, if you want, you can also go for this advance pricing agreement for the past 4 years as well. But please ensure that for the past 4 years, it is not a pick and choose. Meaning you will have to go for either all 4, or you can ignore all of them. Future 5 mandatory, past 4 as a choice given to you. But if you choose past 4, you have to choose all past 4. Whenever an APA is entered into, it is binding on the person entering into the APA, and it is binding on all income tax authorities which are overriding this, which are under the jurisdiction of this APA. But this APA will not be valid if case there is laws changes, if case there is a change in law. Yes. Then what is the provisions of rollback period? They are coming and saying, for all the people who are entering into a rollback period, the following conditions need to be satisfied. In the past 4 years, rollback will apply to all those cases where the international transaction has been entered into, meaning you cannot pick and choose, all the years will be taken into consideration. Second, the return of income for these relevant periods should be filed within the due dates, meaning if any of the returns in the past 4 years were filed belated, those years are not permitted for rollback. Balance years will be taken into consideration. The report in respect of these were filed in accordance with section 92E, meaning you filed your 3CB properly. Rollback has been requested for all the past 4 years. And application is made seeking rollback with a fees of 5 lakh rupees. You have to mandatorily satisfy all the conditions. But the provisions of rollback also come and clarify that if a rollback is going to result in reducing the income or increasing the losses, then what was declared in the return itself? If the rollback is going to result in decrease of income or increase of losses and what it was there in the return itself, then the provisions of rollback will not apply. Like I said, transfer pricing primary rule itself was that you should not get benefits beyond what you expected. And therefore they will deny those things. How do you do a procedure for giving effect to APA? The moment you get an APA and the return of the income is not filed for those periods, in that case you will ensure that you will file the return keeping the APA in mind. For those years where the return is already filed, assessee will now have to file a modified return within 3 months from the end of the month in which the APA is entered into. Meaning after the APA is finalized, 3 months from the end of the month, you will have to file a modified return proposing those changes which the APA has requested for. Third, if they are coming and saying that the APA is still pending, APA is done but the assessment is still pending, in that case what will happen is you will go to the income tax officer and you will come and inform that I am filing a modified return, therefore you withdraw the assessment. Don't make any adjustments. And in case there is an assessment which is already closed, assessing officer will remodify the order. And pass a fresh order within 1 year from the end of the financial year in which the modified return is filed. Yes. So if the case is pending, then the assessing officer will take that into consideration. But if the case is closed, then he will get additional time to file a revised order, taking into consideration the APA adjustments. Yes. Few things which you need to not read from exam perspective. These are all simple clarifications from APA perspective. You can ignore it and go. Yes. The one thing which you need to keep in mind from an exam perspective for the APA is that they come and say if the entrance transaction is up to 100 crores, you'll have to pay a fees of 10 lakh rupees. If it is more than 100 crores but less than 200 crores, you have to pay a fees of 15 lakh rupees. And if it's more than 200 crores, you'll have to pay a fees of 20 lakh rupees. This is for the future 5 years. But for the preceding 4 years of rollback period, no matter what the international transaction is, you will have to pay a fees of 5 lakh rupees. Please keep in mind this fees. This has been tested in exam and MCQs a lot of times. So please keep that in mind. Yes. Last few topics when I'm coming and talking about section number 93, which comes and says that if you're going to enter into a transaction if you're going to enter into a transaction with a non-resident, in such a way that you're transferring his income to him. If you're transferring your income to him, it will still be clubbed in your hands, same as clubbing provisions, nothing so great about it. You can ignore it and go. Section number 94A, please mark this as important. This has been tested in exam multiple times, where they're coming and saying that if you enter into a transaction within NGA, a notified jurisdictional area, income tax comes and says that if you enter into such transaction with a notified jurisdictional area, then all these transactions will be treated as an international transaction. Even if the other person is not my AE. NJA basically tax havens, people. It's basically tax havens, but tax havens which are notified by CBDT. At this stage, CBDT has not notified any NJA, so therefore it is okay. But if you enter into a transaction with an NJA, then whatever transaction you enter into will all be treated as an international transaction. And further, the benefit of the plus or minus 3% will also not be available. Which means if you enter into such transaction, whatever is the arm's length pricing which gets decided becomes the final price. If your transaction price is less than that, they will take that into consideration fully without even looking at the plus or minus 3. From a payments perspective, they are coming and saying all these transactions will get disallowed. If the documentations are not maintained appropriately. And whatever payments you make to this NJA will be liable for a higher TDS. It will be rate of section, rates in force, or 30%, whichever is higher. That's what the provisions come and say. As regard to receipts, any receipts coming from an NJA will be treated as an unexplained income. Unless and until you offer an explanation of to where the source is the money coming from the NJA. As to you explaining the source of the money which NJA received from, and this explanation is satisfied by the officer. Only in that case will this income be treated as a normal income. Otherwise, all these incomes will be taxable under the hands of the assessee. Yes, leaving you with the last topic of transfer pricing, which is section 94B. This transfer pricing topic of section 94B comes and clarifies that if you enter into any transaction where you are borrowing money from your AE, and the interest which you are planning to pay on this money, along with any other incidental interest like guarantee, commission fees, and whatever it is, if that exceeds more than 1 crore, the provisions of 94B will apply. Yes, I'm repeating myself once again. If you enter into a loan transaction with your AE such that you're required to pay more interest than 1 crore rupees in the current year, the provisions of section 94B will get applied in your case. This will also apply in case you take a loan from a third party. For which your AE gives a guarantee. Or in that same third party, the AE is putting same money. So which means I'm coming and saying, if I take a loan from AE and the interest goes more than 1 crore, or if I take loan from a third party for which AE gives a guarantee, in that case, the provisions of section 94B will apply. This provisions of section 94B will not apply in case the person is engaged in the banking business, in case it's a notified NBFC, or it is an interest which is paid by an Indian payee of a non-resident. Yes. Now, what are the provisions coming and saying? If you enter into any such transaction, whatever interest you pay to the AE, if it exceeds 30% of the earnings before interest, tax, depreciation, and amortization, whatever interest you pay, if it exceeds more than 30% of EBITDA, then in that case, whatever excess interest you pay will get fully disallowed. In the current year. So if I am coming and saying that my EBITDA is 100, you can maximum pay an interest of 30 rupees. If you pay interest of 40 rupees, they will come and say 10 becomes disallowed. Now this disallowance of 10 rupees will be carried forward by you and will be allowed in the future years for the maximum period of 8 years. This 10 rupees which you are carrying forward will be allowed for a period of 8 years, with the condition that in those years also it should be within the 30% bracket. Meaning, if the interest falls within 30%, you can take this and you can adjust it in that year. But if the interest goes beyond 30%, then you will not get the deduction. So please bear that in mind. Yes or no? Yes, this is your provisions relating to 94B from an exam perspective, 94B has also been tested multiple times. So if you have some questions to be solving against this, please definitely solve those questions. It'll be really fruitful for you. It'll be really fruitful for you. And that completes your topic on transfer pricing. That completes the topic on transfer pricing. I hope this was useful for all of you. If you have felt is useful, please let me know, and I'll be happy to take this forward and do the balance revision topics for you as well. Yes, the balance important critical topics like assessment procedure, the transfer pricing, the TDS and the assessment procedure is also being shot, and we'll be soon circulating it out to you. If there is any other topics also which you feel are critical and important for you and you may need to know it, please let me know and I will have those shot as well for you. Yes, until such time, thank you people. Take care and happy reading.